going on today, YouTube? Today we're going to talk about the S&P 500 and what you should do while the market crashes. If you've been watching it for the last few days, you know there's a lot of things coming back up about the pandemic. There's a lot of uncertainty in the world, and there's a lot going on. Anytime there's uncertainty, the market crashes. So let's get into it. All right, let's just look at a chart of the S&P. So 5 years, we'll even hit max real quick. Max, you can tell this chart's only from 1980, but from 1980 to 2020 today on October 29th, 2020, it has went up a total of 2,466%. Now, it's pretty good. If you just kept on buying over time, you probably have a big sum of money by now. What we got to get into is these market crashes happen over time. They always do happen. You can look at the year 2000 when the market fell. You can look at the year 2008 when the market fell. You can look up here. We've had a lot of volatility right now. You can look even back in here, 1987, market fell. The only reason these market drops look a lot more drastic than they did back in the earlier years is because it's all off percentages. And now that the S&P is getting higher and higher, it has to look like it's dropping farther and farther down, even though it's still dropping the same percentages. So what to do with your money? If you are investing for the long term, you're not just in, say, you're not in on margin, you're not in using debt, you're not in using all those dangerous things that you could use. That's how you can lose a lot of money. If you're actually in here, you're investing for a long term, you're not planning on selling, you don't have to worry about anything. The only thing you can do when the market drops, depending on where you are in your investing career, is look to manage your assets. And what I mean by that is you have a set percentage, how much you want on a regular S&P, how much you want bonds, how much you want treasuries, how much you want so on. I don't know what your current outlook is or what your current plan is, but as you get farther and farther, you want to get less into stocks because they're more volatile. And when I say further and further, I mean closer to retirement age. A lot of people go less into stocks and more into bonds, more into fixed, more into safe assets. And yes, the bonds can fall the same as stocks when they do, but they typically don't fall as much as the stock market can. So different stages of your life, you're going to have different percentages that you allocate to all of your investments. And when you're young, say 20, 30s, 40s, maybe even early 50s, you may consider just being all in stocks because you're not planning on touching or using that money. It depends when you plan on touching and using that money. Say in your 50s and you don't plan on retiring until you're 70, you probably could stay all in stocks. It all depends when you're planning on touching that money. A lot of people invest it and they never plan on touching it again. And what I mean is eventually it'll get so high that the dividends that you get paid for investing in these stocks or indexes or ETFs will pay out what you need for retirement. So in a way, you never have to touch that money ever, that base that you put in. And that's the ultimate goal. You live off your dividends. Say you're getting late into your investing career and closer to retirement. This is a great time when stock market falls, stock market goes up. Always look at balancing. You don't have to do this every day, every month. You can do this every quarter or every year. Look at your portfolio and decide, am I getting too heavy in stocks? Am I getting too heavy in bonds? Am I getting too heavy in treasuries? Am I getting too heavy in gold? You got to come up with your fixed percentage in your portfolio that you want for each of these. And then just decide from there, okay, stocks they've been on a tear. Say, not right now, but stocks from 2008 to 2000, you can go with 18 or 19. Figure at the bottom, if you kept on consistently buying up till the beginning of 2020, that's 352%. Most likely, this was one of your best performers out of your entire portfolio. So since there's so much extra money in there, you might be getting too heavily weighted in stocks. So that's time to sell off some of your stocks and reinvest them into something safer or something else that you put an allocation to, a percentage allocation to, in your overall portfolio. Your portfolio should be good for years. I mean, it might change over time. Your portfolio outlook is probably going to be different in your 20s and 30s and 40s than it is in your 50, 60, 70, 80, 90. That's just how it is. You want to be more risk. You have time for risk. So early years, that's when you can put in the most risk. And stock markets, it's risky. Yes, over time it goes up and to the right. But at the end of the day, it's something you're throwing your money into that can crash, can fall. And that's another reason why you never invest on margin. Investing on margin is using other people's money as your own, putting it into the market. When you do this, you can get trapped. If the market falls, say the market would have a big collapse, go down back to 2007, 2008 levels, your brokerage will have margin calls on you. Margin calls. They'll send you a letter. They'll probably send you an email today. They might even still mail out a letter. Who knows? They'll probably send you an email and a letter. And they'll say X amount of dollars is due because your leveraged assets are falling. And if you don't have that money, they will take everything you have in that brokerage account. So that's all we're going to talk about today. Don't listen to all the noise out there. Keep your money invested how you plan to. Come up with a plan. Come up with a set asset allocation and use that forever. Use that as long as it's good. Do some rebalancing here and there, and you'll be on the right track. Don't just listen to people be like, oh my God, stock market's crashing. Sell all your stocks. Don't have a plan for it and sit on your money, because we all know inflation will eventually occur. And at the same time, the dollar's value has just been decreasing. So if you found something useful out of this video, leave a like on it. Subscribe if you want to see further videos from me. And leave a comment below if you got any questions. See you in the next video.